With the name of Allah. This is lecture number 8 in Management Accounting Principles for the third year Faculty of Commerce. In this lecture, we will study Chapter 3, Capital Budgeting for Long-Range Planning. We will study in this chapter capital budgeting. After studying this chapter, you should be able to: Number 1. Define capital budgeting, explain budgeting, and explain the effects of making poor capital budgeting decision. Number 2. Determine the net cash flows after taxes. Number 3. Evaluate projects using the payback period. Number 4. Evaluate projects using the net present value. And number 5. Evaluate projects using the internal rate of return. First of all, I want to explain the difference between financial budget and financial plan. Financial budget includes cash budget and capital budget. Financial plan includes master budget, financial indicators, etc. Master budget includes financial budget and operating budgets. That means financial budget is a part of financial plan. The definition of capital budgeting. Capital budgeting or investment appraisal is the planning process used to determine whether an organization's long-term investments are worth the funding of cash through the firm's capitalization structure, debit, equity, or retained earnings. You can use capital budget to evaluate your new project before you start it, to know whether the long-term investments are worth the funding of cash. You can get the fund from debit, equity, or retained earnings of another project. Capital investment decisions have many features. Because capital budgeting depends on analyzing alternative long-term investments and deciding which assets to acquire or sell. So the outcome is uncertain. The investment involves a long-term commitment. Decision may be difficult or impossible to reverse, and large amounts of money are usually involved. Because my resources are not enough, I will choose the project with the most profitable return on available funds. Your limited investment fund make you choose among alternatives. You may make plant expansion, buy new equipment, or make office renovation. Project selection method. Many formal methods are used in capital budgeting, including the techniques such as payback period, net present value, internal rate of return, profitability index, accounting rate of return, average accounting return, equivalent annual cost, and real options valuation. We'll study the first two methods in this lecture, inshallah. This method uses the net cash flows from each potential investment or project. So we need to know what is the meaning of cash inflows and cash outflows and the net cash flows. To calculate the benefits and costs used in capital budgeting decision, you need to know cash inflows and cash outflows. Let us start by cash outflows. Cash outflows include initial investment, incremental operating costs, and repairs and maintenance costs. Initial investment such as machine or equipment cost, incremental operating costs such as direct material and direct labor, repairs and maintenance costs such as machine breakdown cost. Cash inflows include cost saving, incremental revenues, and salvage value. Incremental revenues such as sales revenue and service revenue. Cost saving such as tax saving. After calculating cash inflows and cash outflows, we can calculate the net cash flows. The net cash flows equal cash inflows minus cash outflows. Example 1. A company is considering the purchase of new equipment for $120,000. The equipment is expected, number 1, to have a useful life of 15 years and no salvage value, and number 2, to produce cash inflows or revenue of $75,000 per year, and cash outflows or operating costs of $50,000 per year, ignoring depreciation and taxes. Required, determine initial costs or initial investment. Number 2, determine the annual net cash flows. Here a company purchased a new equipment by $120,000. This amount is initial cost or initial investment. But the revenue and operating cost is the annual cash inflows and annual cash outflows. So the initial cost is $120,000. This amount is cash outflows. The annual net cash flows is calculated as follows: cash inflows or revenue 75,000 minus cash outflows or operating costs 50,000 equal net cash flows $25,000. Revenue is cash inflows and operating cost is cash outflows. What about depreciation and taxes? Depreciation expenses reduce the amount of cash outflows for income taxes. That means as depreciation increase, income taxes decrease. That will make saving. So tax saving can be calculated by this equation. Tax saving equal tax rate times depreciation amount. Example 2. A company uses straight line depreciation. It has depreciation expenses $8,000 per year and a 40% tax rate. Required, determine the amount of the tax savings. So the tax saving equal 40% times $8,000 depreciation amount equal $3,200. The first method to evaluate a project is payback period. The payback period is the time it takes for the cumulative sum of the annual net cash flows from a project to equal the initial investment. The payback period answers the question, how long will it take the capital project to recover or pay back the initial investment? So you can use this equation to calculate the payback period. The payback period equal net initial investment divided by annual net cash flows. Let us take an example. Example 3. A departmental manufacturing company is considering a new capital investment. The following information is available on the investment. The cost of the machine will be $72,096. The annual revenue if the new machine is acquired will be $60,000, as well as the annual operating costs will be $40,000. The machine will have a 5-year life, at which time the terminal disposal value is expected to be 0. The department is assuming no tax consequences. The department has a 10% required rate of return required. What is the payback period of this investment? 3 years, 3.6 years, 4.2 years, or 5 years. Payback period equal initial investment divided by annual net cash flows. In this example, Initial investment equal $72,096. The annual net cash flows equal revenue minus operating cost. That's mean 60,000 minus 40,000. So the payback period equal 3.6 years. By the end of this lecture, you have skills to calculate the payback period. In the next lecture, inshallah, I will continue the net present value. Thank you. Goodbye.